Hello, everyone. Welcome to this second installment of our Tax Playbook Series, Retirement Tax Traps, the mistakes that could cost you thousands. Most people spend decades saving for retirement. Very few spend time planning how they'll withdraw those dollars. The result is that many retirees unknowingly pay thousands in unnecessary taxes. Today, we're going to discuss some of the biggest tax traps that I see. So, without further ado, let's get started. As you know, I'm Kevin Thompson, founder and CEO of 99 Capital Group, certified financial planner, retirement income certified professional, and an enrolled agent. I'm the founder of 99 Capital, former Major League Baseball player, turned tax professional, and financial planner. And again, been featured in all these different media and enjoy what I'm doing. Thank you for joining us on this 90s podcast station, we're live giving you guys the insight on the current environment as well. We do a lot of things from the podcast section where we talk about the economy, finance, and of course, some topics that I get from my clients as well. So I like to give that to you guys. Share, like, subscribe. We appreciate it. But today, our mission is helping you guys in regards to the retirement dilemma that we so find ourselves in. So today, many people assume that their taxes automatically drop once they stop working. For some, that may be the case, but for others, not so much. What they often forget is retirement introduces entirely new tax issues. For example, Social Securities and RMDs. I mean, these benefits can become taxable and mandatory because of the withdrawals that you're going to have to face later in life. Tax deferred accounts can unintentionally push you into higher marginal tax brackets. That leads us to Medicare surcharge. And then this is what we're going to be talking about today. We're going to be talking about these five different things or six. Medicare surcharges, higher income levels during retirement can trigger significant increases in Medicare Part B and D premiums. We're going to be talking about capital gains and portfolio needs, how rebalancing is crucial, and selling assets to fund lifestyle can trigger taxable events, even if they weren't accounted for. And of course, we'll talk about the widow's penalty, which I think is something that needs to be addressed. Transitioning from two individuals to one, compressed tax rates, how that's going to impact people. Because again, retirement isn't tax free. So let's talk about where retirement income comes from. Of course, we have Social Security. People call it a government provided benefit, but no. It's actually your own money. However, if I pay in the payroll taxes, $1, that $1 is currently spent by someone else. So it's not like the government is giving you anything. This is just something that the government administers, but not giving you anything. So let's just be clear on that. Taxability depends on total combined income. We have 401k plans, traditional IRAs. Some of those are tax deferred and tax post-tax, pre-tax, and post-tax. We have pensions, again, defined benefit plans. Now, most of those have gone away to the wayside, but for many retirees, they're still receiving those. Brokerage accounts, flexible, taxed on the way up. Some of them have qualified dividends inside. We'll get into the crux of those here in a minute as well. And of course, we have Roth accounts, tax deferred. You have tax after tax contributions going in, tax deferred growth, tax free withdrawals, if certain parameters are met. So it's important to understand these types of accounts. So let's just start with the tax trap number one, Social Security taxation. Depending on your total income, up to 85% of your Social Security may be taxed. If you're not having this conversation with your advisor, if they don't know what uh, your qualified income is, if they don't know what the income benefit is, the formula, that needs to be addressed. They're not showing you, hey, this is how much of your Social Security is taxed each year. Most people aren't at 85%. Most people, the effective rate's roughly in the 50 or 60 range, depending on where they are. Needs to be addressed. Again, there's a formula here. Adjusted gross income plus non-taxable interest plus 50% of Social Security. That's the formula. Withdrawals from retirement accounts should be planned to manage your total tax profile and avoid unintended spikes in taxable income. Plain and objective here, you got to be proactive. Withdrawal strategies can help minimize the percentage of benefits subject to taxation. Number two, we talk about IRMAA. Many retirees focus on taxes and forget about Medicare. A Roth conversion may save taxes, but Medicare premiums may go up 2 years later. Everything is connected. Everything is connected. I'm going to say it again. Everything is connected. IRMAA, what is it? It's the additional amount you pay for your Part B and Part D premiums for higher income earners. Why are we paying that, Kevin? Are we getting more services? No, you're not. You're just paying out. It's a tax. Call it what it is. 2026 thresholds: 109,000 for individuals, 218,000 for married filing jointly. Here is the strategic impact. Exceeding these thresholds triggers mandatory premium surcharges, highlighting the need for proactive income management in retirement. But this one thing I want you guys to understand about this chart, or about this tax trap. The additional increases in IRMAA are at compressed rates. What do I mean by that? I think it's like a $30,000 to $50,000 increase every single time, maybe $30,000 increases. You jump to the next IRMAA bracket, and the next IRMAA bracket. They're tier 1 IRMAA bracket, tier 2 IRMAA bracket, tier 3 IRMAA brackets. And the IRMAA bracket increases are hideous. You can go from $200 a month per person, by the way, to $300 a month, to $400 a month, to $500 a month. It gets really drastic really quick. So we need to have those conversations to make sure we're minimizing that as much as possible. RMDs, many retirees delay planning and allow large IRA balances to accumulate. RMDs begin, suddenly income increases, taxes increase, Medicare premiums increase. Planning early matters. Again, everything is connected. The IRS mandates that you take money out of this account, sometimes 73, sometimes 75, depending on the time of day. Whatever they always change it. Distributions must occur regardless of personal cash flow needs or financial intent. Mandatory withdrawals are taxed as ordinary income, potentially pushing retirees into higher marginal rates. Increased AGI from RMDs can trigger higher IRMAA, raising Medicare Part B and Part D premiums. Everything is connected, like I said before. I'm going to say it again. This is one of the most overlooked things, I believe, in retirement planning. When one spouse passes away, income often stays relatively the same, but brackets are compressed. The surviving spouse can find themselves paying higher taxes despite receiving less income. So you transition from married filing jointly to single. That narrows the brackets. Income that was previously taxed at a lower rate now faces higher marginal brackets. The survivor often faces higher tax liabilities on the same level of household income. Household income often remains steady, but the tax efficiency of that income drops significantly. I've seen this time and time again. And this is one of the things that needs to be addressed. Now we're talking about capital gains stacking, tax trap number 4. Many retirees believe capital gains will receive a special treatment, and they don't. While often true in some cases, gains still increase taxable income and can trigger other consequences. If you start stacking capital gains, your Social Security is going to get taxed higher. Yes, everything is connected. Like I said, Social Security goes up, taxation goes up, possibly higher Medicare premiums. Marginal bracket starts to creep. So instead of 15%, you may be in a 20%, or maybe you get that NIIT, the 3.8% additional amount. You may lose phase outs. Oh, you know what? I was looking for that enhanced deduction. Now I'm getting less and less than my standard deduction, and I thought it was going to be the additional 12,000. We're getting enhanced deduction. Now it's getting phased out because I took capital gains. We have to watch these things. The majority of the issue is going to be in Social Security because your Social Security starts to get taxed at a higher rate. Tax trap number 6. ignoring Roth conversions. This period, again, we call the period between retirement and requirement RMDs, critical tax planning window. Income optimization. We got to utilize lower taxable income years to shift assets at reduced marginal rates. Practically converting traditional 401ks and IRAs funds to Roths can permanently reduce RMDs in the future. It prevents tax bracket creep and serves as a hedge against future tax legislative changes. This chart right here, I believe, is one of the most powerful charts that you're going to be seeing today. We have our retirement date. We have these gap years. This is what we just talked about. This is the planning opportunity from retirement date to when we start taking Social Security to the RMD commencement. These gap years is where we're going to start talking about maybe QCDs, maybe we're going to talk about Roth conversions, capital gains harvesting, qualified charitable distributions, by the way, QCDs. Those are the types of things where we can minimize future taxation. And we didn't talk about QCDs much here, but qualified charitable distributions, if you're 70 and a half, I think it's powerful to come out of a traditional IRA for sure. Now, we diversify investments. We should also diversify our tax exposure. The goal is flexibility. Different accounts allow us to pull income from different buckets in different situations. So we have a taxable bucket, standard brokerage accounts, individual stock savings, provides liquidity immediately. You can get access to assets quickly. Tax deferred accounts, traditional IRAs, 401ks. That money is pre-tax in most cases. All taxed as ordinary income. But let's go back to the taxable brokerage account first, because again, that money's taxed on the way up. It's also taxed with qualified distributions, whether it be qualified dividends or non-qualified dividends, which is ordinary income. We have Roth IRAs, tax-free bucket, Roth 401ks, HSAs, buckets that will allow us to pull assets tax-free as long as we meet certain stipulations. Having these multiple buckets allows us to pull different levers at different times when needed, especially when we're trying to control taxes. So back to the common retirement mistakes, tax mistakes. Again, none of these mistakes are catastrophic, but together they can cost tens of thousands of dollars over time. Taking Social Security too early, lacking Roth conversion strategies, ignoring IRMAA altogether, poor withdrawal sequencing, waiting too long to plan. These are powerful things that, if not taken seriously, can cost you, not can, will cost you tens of thousands of dollars. I've heard people on TikTok, oh, I'm going to take Social Security at 62. Okay, congratulations. There's no other asset out there that's going to give you an 8% return guaranteed if you delay 1, 2, or 3 years. There's not one. Name one. Name two. Not going to happen. But Social Security will. Now, I hear people saying, well, they're saying Social Security Trust Fund is going to be bankrupt. Well, I say go back to our 90s podcast station, listen to what we talk about in the Social Security realm, and it may enlighten you. But today, on this webinar, we're talking about taking it too early and getting a permanent reduction in lifetime monthly amounts. Don't let the TikTokers tell you one way or the other. Get with somebody, get a professional that knows this, and run some scenarios for you to help you understand. Now, again, there's people that have to take it early because they don't have other assets. But for the majority of you, no, you can wait. Strategic tax efficiency. Good tax planning isn't tax avoidance. It's understanding the rules and making timely, intentional decisions. The goal is often lifetime tax efficiency, not simply reducing taxes this year. True tax efficiency is not achieved through short-term avoidance. The right approach: pay the correct amount, Don't try to short the system. It's not worth it. Focus on long-term tax trajectory over reactive measures. Minimize total liability over the financial lifetime. Utilize tax advantage vehicles to enhance long-term compounding. The IRS cares about your withdrawals, not your balance. Mastering distribution efficiency is the key to minimizing tax liability during retirement. So most retirement plans focus on accumulation. Few focus on distribution, but distribution is where taxes show up. The difference between good retirement and a great retirement is often found in how efficiently you can draw income. Thank you guys for listening today. I like to keep these short. So if you have any questions or about this discussion, we invite you to share your questions regarding retirement tax planning. Are here to discuss withdrawal sequencing strategies, tax implications of RMDs, traditional versus Roth considerations, and managing tax brackets in retirement. We are here to help. And if you have any questions, feel free to reach out to us via our website, www.9icapitalgroup.com. You can reach us on social media at 9iCap, and or you can email us at info@9icapitalgroup.com with your questions, and we'll get back to you as soon as we can. Thank you guys for listening. Make sure you subscribe and support the channel. We are here to give you balance, unbiased, and educational responses to your questions. Thank you guys for listening. Stay humble, stay safe. We'll see you again soon.